Hi, this is Aaron Engelman from Two Teachers Tax Service in Lyman, South Carolina. One of the questions I get asked the most is how does inheritance work and what is taxed? Inheritance has complex tax rules. However, most Americans do not pay federal inheritance or estate taxes. The tax implications depend on the type of asset inherited, and this presentation will include the tax treatment of inherited IRAs, Roth IRA versus traditional IRA rules for inheritance, the concept of step-up basis, and then what kind of assets are not taxed at inheritance. First of all, the taxability of inherited traditional IRAs for spouses. Traditional IRAs are funded with pre-tax dollars, so distributions are taxable to the beneficiary. Now, spouses can treat the IRA as their own, or they can roll it into their IRA. And the benefit of this is it can delay required minimum distributions until the spouse of the deceased reaches their own required minimum distribution, or RMD, age. Now, what about non-spouses? Well, non-spouses after 2019, there was something called the Secure Act, and it changed how we can distribute funds to non-spouses. And so the Secure Act requires that most beneficiaries withdraw the entire balance of an inherited traditional IRA within 10 years. These withdrawals could be taxed as ordinary income, or I should say they are taxed as ordinary income. And so we have to be thoughtful about this from a tax efficiency perspective, knowing that large withdrawals may increase your tax bracket. Non-spouses before 2020 may qualify for lifetime stretch distributions. And what this essentially means is you can distribute your inherited traditional IRA over the course of basically the rest of your life. Now, what about Roth IRAs? If you inherit a Roth IRA, these Roth IRAs are funded with after-tax dollars, so distributions are generally tax-free. Spouses, again, can treat the Roth IRA as their own, and qualified withdrawals remain tax-free. Remember, that's the money that you put in, and then any proceeds from that money that you put in, investment results. Non-spouses must still follow the 10-year rule, so they have to empty out that IRA within 10 years. However, the distributions are still tax-free if the account has been open at least 5 years. And so those distributions can be made up of the principal of the Roth IRA plus any investment results that are inside of that Roth IRA. Another important concept is the idea of step-up basis. So here's how this works. A step up in basis resets the asset's cost basis to its fair market value on the date of death. And the effect is it erases appreciation during the original owner's lifetime in terms of taxability. So beneficiaries only pay capital gains tax on growth after the inheritance. So let me give you an example. Let's say somebody that you inherited something from bought this item for $50,000. And over the course of their lifetime, it increased in value so that the value at their death was $200,000. The step up in basis adjusts that $50,000 original basis to its value at the date of death. So when you inherit it, your new basis for this item would be $200,000. So if you were to sell it immediately, there would be no gain. The value is $200,000. You sell it for $200,000. No gain there, and so no tax. Now, let's say you held on to this and you sold it later for $220,000. Well, now only $20,000 of this would be capital gain. This happens often to people when they inherit a house And so perhaps you inherit a house from your parents. They purchased it for $30,000. The value today now is $300,000. And a lot of people are really worried, I'm going to have to pay taxes on that difference between the original purchase price and the value at time of death. And that's what step up in basis helps those who inherit property, they avoid that. What is not taxed when inherited? Well, cash, property, and personal assets are not taxable as income when inherited. Now, if we think about the last slide, if you hold on to them and then sell them later for more than the value when you inherited those assets, well, then that would be capital gains. But if you sell them immediately, or if you just inherit them and use them, that's not taxable. Life insurance proceeds are not taxable as income. However, interest on installment payments could be taxable. But if you get a lump sum from life insurance, as a rule, that's not taxable. Most estates avoid federal estate tax due to the $13.99 million exemption per person in 2025. So if you inherit something from somebody, unless their complete estate is $14 million or over, there's really not going to be any federal estate tax due. Spousal transfers, there's an unlimited marital deduction. So let's say your spouse passes away and you inherit as a spouse $50 million. Well, as long as you're a U.S. citizen, you have an unlimited tax-free transfer. And so that $13.99 million exemption does not apply. Estate tax versus inheritance tax. Estate tax is federal. This is paid by the estate before assets are distributed. This affects only very wealthy estates due to that very high exemption. Now, inheritance tax by state is paid by the beneficiary after receiving assets. And as of 2025, it's only imposed by 5 states. Many states exempt spouses and close relatives. So for the most part, unless you live in one of these 5 states, you're not going to have state inheritance tax. Here's some strategies for beneficiaries. First of all, if you have inherited an IRA, you want to spread your traditional IRA distributions across the 10-year period to avoid bracket inflation. You don't want to wait and take a little bit out for 9 years and then all of a sudden have a huge sum in the 10th year because you're going to definitely creep up into a different bracket. Step-up assets. Consider timing your sale. Post-inheritance gains are taxable. There are state-specific rules, so check whether your state levies estate or inheritance tax. And if you're not sure, contact us. Whenever you inherit something, it's a good time to consult professionals. Two Teachers Tax Service can help optimize timing, withdrawals, and asset management for tax efficiency. If you have any questions, please contact us at 269-449-8277 or by email at twoteacherstax@gmail.com. Thank you.